Welcome to TheoTrade. This is Don Kaufman. It is March 1st, 2017. You are watching the Theo Night video. First and foremost, following the presidential speech, we have a rather explosive rally on our hands. You know, the S&Ps, they were a bit higher, even crested into the 2401. They faded ever so slightly towards the close, and the close happening just a few seconds ago. But again, we had some sell side activity that got rather intense here just the last few minutes of trade. But what does it matter? The S&Ps are still up 32 points, okay, from yesterday. All major indices closing right here at all-time highs. In fact, let's take a quick glance at just that. So for that, I'm going to go over to the SPX. I'm going to happen to pull up a 9-month on the SPX just to get an idea of how explosive this rally happened to be. So there's the SPX closing, okay, at roughly 23.95, but seeing a 2400 print. So with all of this, and to see how explosive the market happened to be, let's go back and just do a quick glance at what was really expected. So for those of you that tune in on a day-to-day basis here at TheoTrade, you'll know that I'm much less a market technician. And a market technician, you know, listen, you could be a market technician all you want. You're not going to be able to explain a marketplace moving from 2100, that's the S&Ps at 2100, and a straight shot to 2400. Gotta love the fact that it was a nice round number. I mean, literally 2100 to 2400, that's a 300-point move inside of the S&P 500, roughly from the beginning of November to ultimately right here, right now. And again, you know, it's just November, December, January, February, a 4-month, you know, period of time where we had a 300-point swing to the upside. That doesn't even include the fact that the S&P futures, if you looked at the S&P futures, the move is even more dramatic given the fact that the night of the presidential election, we touched down to almost 2,000, right? So you almost have to hesitate to see that. So when I say that not even a technician can explain this, okay, first of all, in looking at the SPX in any, like, you know, few month period, let's look just a few months out over here. For example, I will go 91 days out in the SPX, and you'll see a normal move in low volatility is about a 140-point move. Okay. In the average year, let's just go find some options that are, you know, near 365 days. There's 323 days. In a normal year, a 320-point move is more quote unquote normal. So from a statistical standpoint, forget about, you know, what you might think about this. It's overbought. You know, that's Captain Obvious kind of stuff. It is overbought, right? But neither here nor there. None of that matters when we're exploding, of course, to the upside. Now, from a statistical point of view, how stretched is this market? Well, first of all, let's not even look, okay? Let's not look on a broader period of time saying that, you know, hey, listen, there's been a 300-point move. We just recognize that it typically takes what? Okay, almost a year to move 300 points to the upside. In a more typical, like, you know, 4-month period of time, look, you can even go to a 120-day period. $170 move is more quote unquote likely. Okay, so again, neither here nor there. However, with everybody and all the media jumping all over this, and they're like, you know, we're exploding to the upside over here. Have we really had an explosive rally? Okay, other than the fact, yeah, of course, we've had a 400-point move, but this week, how crazy has the move been this week? And I think you guys will actually find this quite interesting. But let's just go back to the beginning of this week, okay? Because again, you're seeing a really explosive move today. Again, the SPX is going to close up about 32 points. The S&Ps are up about 32 points. And this happens to be yesterday's data, the 28th. But go back to the 26th, because I do this every single weekend, and I do it for a very, very specific reason. You want to know what was expected on any given week. And in this particular week, and again, all I've done is back this up, okay? Back this up over here to Sunday, which takes us roughly to Friday's data, all right? And we're now looking, not today, but we're being forward-looking, looking at Friday's expiration. And there was a 23, and we'll just round it in this case, $23.86 move. So let's just round it to $24. There's a $24 move that was quote unquote expected. That's from a price point of 23.67. Now, just do some quick and dirty math over here. The quick and dirty math is, I call it napkin math. So here's 23.67, okay? And just simply add the expected move to it. Now, we didn't know it was going to go up, but in this case, we know that the market's rallying. So add 24 bucks to it. What does it come out to? 23.91. Okay, so for the most part, earlier this week, the market was projecting that we just tag into the 23.91 level, okay? And immediately you're going to point out, but Don, listen, we're almost at it. We've exceeded it by what? 4 or 5 points over here? This is a $2,400 product, and we're just to the edge of the expected move. But what's the big but over here? The week's not over. You still have 2 trading days left. Now, from here on out, we are teetering right on the edge of expected move. You teeter on the edge of an expected move, it's dangerous territory. Now, what we've seen lately in the markets, and if you look at this from a statistical point of view, what we've seen lately in the markets, in all of these recent weeks, we have ended up inside of the expected move. The biggest burst we saw took us only 3 points outside of the expected move. And I want to reiterate that. The last time that we actually blew through the expected move, you've actually got to come all the way back here to December 7th. Now, I'm not saying that the markets this week cannot blow through the expected move. However, there's a fairly high probability at this point, okay, that you saw the high and we start to come in. And this is not, oh, is this technicals? No, nothing like that. It's hedging activity. So hedging activity is very likely to keep us on the cusp of what was, again, expected, the expected move over there. In fact, okay, something interesting into today's close. So again, I want to reiterate my stance over here that 23.91 was the edge of the expected move. Here we are at 23.95, 23.96. Everybody's cheering like, it's 1999 all over again. Well, I guess 2000 if you're looking at the markets, but they're cheering like it's a party. And yet we're right on the fringe of what was expected for the entire week. And it's Wednesday, okay? A lot of room, for what? For us to possibly come in right to the edge of the expected move just because we crossed through it, all right? It's an expected move. It's a probability of expiring inside 23.91 by, of course, Friday's expiration. So given that, okay, we'll watch very carefully over the next 2 days, but there's a high likelihood that we come back in. And I say come in, that's either meander, okay, right at this level, or sell off very, very slightly, okay? Could we see some, huge sell side activity? Absolutely. Now, I'm be clear about this. An expected move doesn't mean we're going to move right to 23.91. It means we're supposed to be inside, or for instance, in this case, under 23.91. Now, one other interesting area that I want to explore, and I saw this the other day too. For those of you that tuned in on Monday, I talked about the volatility futures on Monday as well. The volatility futures, okay, for unknown reasons at this point, the entire last hour being bid up. Typically when volatility futures are being bought into a close, usually means there's going to be sell side activity, right? Well, today there was a little bit of sell side activity, but nothing like you would expect. And by the way, the futures are still open and they're still kind of, drifting just a bit lower over here. Ironically, they're drifting a little bit lower, which that'll reopen the S&Ps tomorrow right close to 23.91. Okay. But if you take a look at this, we did not see that follow through sell side activity to the S&Ps. Moreover, you even had the bonds rallying, okay, with the volatility futures rallying. Is there going to be some sell side activity tomorrow? Well, quite possibly. Again, coming in inside that 23.91 level could be huge. Now, one other area that I really want to focus on, and there's a lot going on obviously in markets, but individual stocks doesn't matter. Nothing matters in individual stocks right now. You're like, Walmart was down. It's neither here nor there. Take a look at this. I have been looking for exactly this for months now. What we're getting are 90 products in the S&P 100 up. Now, I was explaining this live kind of in TheoTrade today, and I'm going to do it again for you guys right now. But for the most part, what we have been seeing lately, even in massive up days, is about a 70-30 advanced decline line to the S&P 100. 70-30. It's just this like slush trade. It's when I say slush trade, it just basically means the market is just content in just, rotating assets and so forth. Here we have correlation back. You look for this 90-10, whether it's up or down. Typically, okay, in much more what I would term normalized markets, what we've seen for years and literally the last decade, when you have a big up day in markets where, the S&Ps are up 30, you should see about 90-10. Okay, and that's exactly what we got today. However, in some of the other recent rallies that we've seen, we've been nowhere near that. Okay, we've actually approached like 80-20. At the craziest, we saw like 85-15, and that was December 7th when we even saw that. So this is one of the first times we've actually seen almost that quintessential all-up day. Is it a sign that correlation has snapped back? Okay, and that we're actually, again, starting to see markets normalize. And that normalization is the fact that, hey, that's a big signal that, all right, markets are starting to normalize over here. Okay, we're going to get correlation back and let's play ball. Okay, no doubt that a one-sided marketplace, when you see the S&Ps, and I'll reiterate this, when the S&Ps trade from 2100 to 2400, it's difficult trade. I'll tell you why it's difficult trade. You're either long or you're long. For those of us that actually trade more actively, okay, you're trying to take positions over here, and it's difficult as a trader to want to continue to be long, okay? Meaning that if you are long in the market, you've probably at some point flipped over and shorted a couple of trades in here. Or, like for instance, for today's trade, you looked at this thing and you're like, wow, I can't believe we were up so high. You probably sold your positions. This is difficult for traders to hold into. Again, look for markets to normalize a bit, and moreover, look for tomorrow us coming in on the SPX right around that 23.91 at the cash open over here. Again, there could be some volatility and some follow through to the downside a little bit as the week progresses. Again, exclusively because volatility futures are being bid up. Kind of tips me off that, again, there could be some sell side activity as the week progresses. Thanks everybody for joining us. TheoTrade. Have a great evening. Bye-bye.